As of now, half the companies in my portfolio have reported their earnings. What I want to do is quickly go through each one and give you the most important takeaway as well as an important warning. Every one of these companies, even the high quality ones, I have a warning to give for investors. So this will be very important to any of you that hold these companies, have them on your watch list, or are considering them at any point, or they also have big influence on the market, and it's just probably important to hear this as well. So before we get started, let's look at my portfolio performance, and you will see here that I am in the green by a decent amount, and it's been such a long time since I've been up this much. I am up 4.1%, that's almost $2,000 in gains, and we've had a very positive January. Of course, the jobs just came in very strong, so we might start to see some pullback. I think there's still some volatile times ahead. I still think we see a recession. Regardless, this portfolio is looking good. And it's a double-edged sword for me because I like to see this wave of green, but I also like to add at good valuations. So I'm hoping we still have some decent pullbacks. I have some cash on the side to invest. I do want to point out Meta. This stock was down 35 to 40% for me for the longest time, and now it's only 11, 12% in the red. And I think this one will be in the green pretty soon. So I want to talk about half these stocks, and we're going to look at the earnings right now. You'll see here, these are the 7 companies I'm going to talk about today. And the one thing you'll notice, they all have something in common except for one. They either missed on their earnings or their revenue, and the only one that beat on both was Bank of America. So let's go through each company and let's quickly talk about the most important takeaway and a warning I have for each. Let's start with 3M. Now, the biggest warning with 3M is that the CEO said that they expect macroeconomic challenges to persist in 2023. This means basically that their sales are going to slow massively due to the high inflation, and a lot of the companies that buy their products already have high inventories of their products, so they're going to also be spending a lot less on 3M products. Now, looking at their financials, their cash is going down, which is not good, and to my surprise, a positive is their long-term debt is going down, but their dividend payout is high at a 59%. I don't think this is at a risk of being cut at this point, but it's something to keep an eye on. So with 3M, the one thing I don't like about this company and why I don't think it's that high of a quality of a company is they don't really have that reoccurring revenue dependably like other companies do. A lot of consumers don't have to buy 3M. They can buy a different product on the shelf. And with a pullback in renovations, people buying furniture, those large ticket items, they won't need those 3M products. And therefore, they're going to depend more on companies who buy their products, which we see aren't going to be buying as much due to the high inventories. So I just don't think 3M provides that great revenue dependency on the companies buying them regularly, and it's just not very solid. Also, they have litigation issues, which they have a lot of that, which is just going to keep them from growing. It's going to just keep them underwater, I feel, for quite some time. So 3M to me is not going to be a good investment, at least for the next couple years. So if you're an investor, you just got to be patient. This is one I'd love to sell out of. I just don't think it's a high quality company. So let's move on to Johnson & Johnson. Now, Johnson & Johnson has 3 segments of its business: consumer health, pharmaceuticals, and the med tech. Now, it's going to be spinning off its consumer health division, so someday we will get shares as investors of a new company. Now, let's look at the total sales on the left. Consumer health brings in $15 billion, pharmaceuticals $52.6, and med tech $27.4. So you can already see the pharmaceuticals and med tech brings in more revenue, more sales, and grows more. So year over year, consumer health grew 3.6%, pharmaceuticals grew 6.7%, and med tech grew 6.2%. So out of all the companies that reported, I think I like J&J the best right now in the short term. It's going to be spending off this business, which is the slowest growth part of its business. It brings in the least amount of revenue. And companies do this so they can focus on growth. And I really think they're making a good decision here to focus on pharmaceuticals and med tech. I think that will provide them long-term growth, and us investors will be able to profit off of that. So my warning here is anytime a company spins off a part of their business, it can get volatile for some time because there's a lot that goes into that. There's going to be headlines. So just be prepared for that. And also, my other warning is when you get shares of that new company, you want to decide if you want to keep or sell. AT&T spun off Warner Bros. Discovery. I got shares of that company and it's been a dud. Companies spin off parts of their business because they aren't doing well or they're the slower growth ones. So I think I will just sell the new business that gets spun off right away and just focus on Johnson & Johnson, put that money right back into what it's focusing on, which I think long term will be good. Now let's look at Microsoft. Microsoft, all their products and services are showing declining growth. And you'll see here with Azure and the other cloud services, each quarter its growth is going down. That said, my warning is for maybe the next year or two, you might see the opposite of what Microsoft typically produces in the stock market, which is solid returns. We might see some lower than average returns from Microsoft. And my warning is, with a high quality company like this, you have to be patient. I can almost guarantee you there will be people selling out of this company because it might trail the S&P 500 for a change or not provide that growth like it has historically. But what they're doing, why I'm keeping this company and will add to it, is because they are focusing on areas of growth, on turning things around. One way is by focusing on artificial intelligence, and Adela said they're going to incorporate it in all that they do. So they are partnering up with this company, OpenAI. They're going to go after Google and try to improve their Bing search engine market share. They're trying to acquire Activision Blizzard to improve their gaming side of things. So with Microsoft, I think there will be a slowdown possibly over the next couple years. So until we see some improvement in growth in all of its products and services, which I think will eventually happen, I think Microsoft will be very successful at this. Of course, that's just my opinion. You want to do your own research. But I think long term, in 5-10 years, you'll look back and be glad you did not sell. So patience with Microsoft, I feel, is my biggest warning because they could have a few years of lackluster performance compared to what investors are used to. Next up is Meta. Now Meta, surprisingly, as I mentioned, they are doing extremely well. We will see here that all of their active users and the different measurements that they do are increasing year over year. But their ad impressions and price per ad is going down, their revenue is going down, and their costs and expenses are going up. So why has Meta boomed so heavily? Well, basically, one reason. Mark Zuckerberg said, Meta, this is their year of efficiency. And that's what investors wanted to hear. So they're going to be focused on cost-cutting measures. And they said our management theme for 2023 is year of efficiency. So my warning for you with Meta is to also have patience because we saw this huge bump in its stock price. I think a lot of people are starting to get in the green or will soon, and they might sell, but it might be worth it to hold on maybe another 5 years because I really think the stock will continue to take off, especially when those ad dollars come back in a big way. That's something I don't think people are focusing on. You know, we saw the slowdown in the ad revenue. Look what it did to its stock price. So imagine when that ad revenue comes back in a big way, what it's going to do to its stock price. So I think it's worth holding on to Meta and being patient. Next up, we're going to talk about Amazon. The one thing with Amazon is you want to focus on its sales in its different segments and how they're doing. We'll see here their online store sales are down 2% year over year. But if you take out the foreign exchange rate because it's negative right now for companies, it actually grew 2%. But I will just focus on that last column. So online store sales declined slightly 2%, but physical stores up 6%. Third-party seller services up 20%. Subscription services, very important, up 13%. Advertising services is up 19%. When other companies like Google, Meta, their advertising is shrinking, Amazon's is going up. So that says a lot about this company and how powerful its advertising side of things is because you go on their app, you search something, you're bombarded with all kinds of different products. And I think that creates one of the best advertising platforms out there. Amazon Web Services up 20% and other up 77%. So for me, my warning is, yes, Amazon might have high expenses, their PE ratio might be high, so I think a lot of investors get fearful with Amazon, and my warning is don't be fearful, take a step back and look at this company. It's got a huge moat, it's virtually growing in all of its areas of its business, and I think long term, the profitability and those margins will improve, and this stock will rocket, and I think it'll be one of my best performers over the next 5 years. Next up is Bank of America. What you want to look at with banks is their net interest margins, or it's called here net interest yield. Basically, the interest income versus interest expense. And this is how a lot of banks make most of their profits. So you'll see here on the right, their interest income is increasing and that net interest yield is going up. That's the yield. That's what you want to look at. And that is proving to show that this company is bringing in more interest than it's paying out. But some warnings here. We've had the Fed rates increase, which is going to help a bank especially make more interest, but also it's going to slow down consumers who take out loans. And we'll see on the left here, those loans and leases are slowing down massively, which is where they make their money from. So if that starts to decline, we will see that net interest yield or margin start to possibly decrease, as well as when the Fed starts to cut rates. So my warning is to you, you want to keep track of this, because right now, Bank of America, I feel, is overvalued. Even though a lot of people say the banks are undervalued, I think you got to keep in mind that this is how banks make a lot of their money. And with the possibility of the loan slowing down and the net interest yield possibly going back down, investors will eventually catch on and it could send their stock price crashing. And that's when I would add Bank of America. But as of now, I think it's overvalued. So my warning is keep track of this every quarter, and that'll help you look at things in a better picture as an investor in Bank of America or any of the other banks. Lastly, AT&T. I have to say I'm a little frustrated with the stock. AT&T, when they spun off Warner Bros. Discovery, they said their main focus is to reduce their debt. So if we look here, the debt in current liabilities is going down pretty significantly, but accounts payable is also going up significantly, which is not good. Their long-term debt was going on a downtrend. I was loving to see that, but as of the last quarter, it's now going back up. What the heck, AT&T? This is supposed to be what you're focusing on, and what investors are really wanting from you is to lower your astronomical debt, and it doesn't look like it's happening anymore. It's going back up, which is bringing up their long-term liabilities and liabilities as a whole over this last quarter. So I think this is what you have to look at specifically with AT&T, and my warning is if the debt starts going on an uptrend again, this stock is going to go down and just continue to be an underperformer. So I definitely want to sell out of AT&T and also 3M if I get the chance. The other stocks I mentioned, I think are great investments. I will hold those. I have no plans as of this point of selling. I only plan on adding. So with that said, let me know what you thought of this video. If you know, what you thought of all these companies with their earnings, my warnings, the one takeaway from each. And if so, I will do this video when the rest of my companies report, when they're finished, and give you the same type of outlook and concept, because I think it's important to see these things, look at things in a different way. And so let me know what you thought. And thank you guys so much for, being a part of this channel. And if you're new, be sure to subscribe. I'm very transparent. I provide the good, the bad, the in-between, and I am very consistent in putting out videos and listening to you guys and putting out the content you want. So we'll see you very soon on Mark Arnold's Finance. Have a great day.